All right, so we've started already. So the topic where we'll be starting with basically is known as the Iasb Conceptual Framework, which I'm currently sharing my screen. Can everyone, hope you can all view my screen, right? The topic, can you all view it? I need a feedback, please.
Okay.
All right, so I'll send these materials to you at the end of today's class. So the topic we're starting with basically is the Iasb Conceptual Framework. The Iasb Conceptual Framework. That is the topic we are starting with today. So what is the Iasb Conceptual Framework? So this Iasb Conceptual Framework basically is like a Bible or Quran to us in financial or corporate reporting, because this is more or less like this is the background. It set out the various concepts for us. For example, if you want to define any item in the financial statement, you have to refer to definition as per the IASB conceptual framework. So it's like the background, the major foundations to any financial reporting or IFRS. So if you attend any IFRS or financial reporting class, the first thing that you'll be taught is this IASB conceptual framework. So IASB means International Accounting Standard Board. That's the meaning of IASB, the International Accounting Standard Board. So this IASB conceptual framework sets out the concept, okay? It sets out the concept that underlie the preparation and presentation of financial statements. So it sets out the concept that underlie the preparation and presentation of financial statement. That is, it sets out the objectives of financial statements, assumptions, characteristics, definitions, and criteria that govern financial reporting. So all these things are what we're going to discuss in detail. So the conceptual framework, like I said, is like the Bible or Quran that governs the financial reporting. So the first thing that you need to understand before reviewing the individual IAS or IFRS is the conceptual framework. This is like the manual. For example, if you look at your Bible or Quran now, it is a book, right? So in each of those Bibles now, you now have various verses, various chapters. So in this case now, the conceptual framework is the main book itself. Then it is from the framework that they now extracted various IFRS, IAS. We have IAS 1, IAS 2. So all these things were extracted from the framework. But the framework itself is the major foundations. That's okay. So under the conceptual framework now, so we will be discussing the following. It's in chapters. So we'll be discussing the following. The first one is we'll discuss the objective of financial statements. So what's the objective of financial statements? We're going to discuss that now. Then we'll also review the underlying assumptions. That is, what are those things that you need to have at the back of your mind before preparing financial statements? Those are the underlying assumptions. Then we will review the qualitative characteristics that undermine the usefulness of information in the financial statements. So what are those characteristics of financial statements? We're going to discuss that under the framework. Then we'll review the various definition, recognition, and measurement of elements from which financial statements are constructed. Then we'll review the concept of capital and capital maintenance, and we'll look at the reporting entities and its boundaries. So these are the various things that we'll be discussing under the conceptual framework. So it should be noted that the framework, so it should be noted that there are some objective of the framework, right? There are some objective of the framework. So basically there are three objectives of the IASB conceptual framework. All right, there are three objectives of IASB conceptual framework. So the number one objective of IASB conceptual framework is to assist and guide the IASB as it develops new or revised standards. So this simply means that this framework assists the IASB to develop a new or revised standards. So that's the first thing. Like I said, that it is from the framework that the various standards are extracted from. So the number one objective is to assist the IASB itself as it develops new or revised standards. So that's number one objectives of the framework. Then the second objective of the framework is, now we that we are preparing financial statements, me and you that are preparing financial statements, so it assists us too in applying those various standards and dealing with topics that are not addressed by the standard. So the framework assists us to in applying standards and in dealing with topics that are not addressed by the standard. So that's another objectives of the what framework. So you can see the number one objective is that it assists the IASB. The IASBs, they are the one that develop IFRS, right? So it assists them to develop a new or revised standard. Then the second objective is that we are the users too. The framework assists us in interpreting those standards or in applying standard and dealing with topics that are not addressed by standard. So I must make it known to you that IFRS is principle-based. It is not rule-based. What I mean by principle-based is because that you can also apply your own initiative. You must not state that the standard says you must use this, so you have to use that compulsorily. So if you have a better way of presenting your financial statement other than the provisions of IFRS, and that your better ways will result into a more better presentations of financial statement, then you can apply it. That is why we said IFRS is principle base. Okay, so the third one is that to assist all parties to understand and interpret standards. So that's the IFRS assists everyone to understand what standard is all about. It also assists us to interpret the standard. So these are the various objectives of the standard of IASB conceptual framework. And please note that whenever there is a conflict between the framework and the standard, please, ladies and gentlemen, the standard prevails. Okay? The reason being that framework is a general document. Okay? It talks about general definitions and everything. Why the standard is specific. Okay? Standard address a specific issues. For example, IAS2 inventory, it's only focused on inventory alone. IAS 16 PPE, that's only focused on PPE alone. So the standard is specific, while the framework just talk about the general definitions and general meaning. So, okay, I already addressed this note that when in the absence of any standard or interpretation that specifically apply to a transactions, then you can apply your own judgments. Okay, that is why I said IFRS is principle based. And note, don't now say that because the standard says that you can apply your judgment, then you now start misleading. The objective is that whatever judgment you are okay, so sorry, I don't know, network keep dancing. Yeah, I don't know why the network is fluctuating here, but apologies. I'm not actually at my place. I'm away, so network is mixed behaving. But can you guys hear me now? I'm back. Hello, can you hear me?
Can hear you.
All right, so let's carry on. All right, so I've explained okay, so now let's start looking at the framework one after the other. So we need to look at it one after the other. So the framework is now divided into various chapters. So the first one is the chapter 1. So chapter 1, objective of financial statement, of objective of financial reporting. That's the chapter 1, objective of financial reporting. So what's the objective of financial reporting? Basically, objective. So basically, why are we an accountant? If I throw this question at us now, what answer will you give me? Why are we an accountant? Basically, what is the objective of all these things that we are doing? Why are we preparing report? Why are we an accountant? Does anybody want to tell me the objective? Does anybody want to tell me? I deliberately, okay. Does anybody want to tell me the objective? Why are we an accountant, basically?
To prepare financial statements from historical records.
Okay. Yeah, that's correct. So I need more. I need more. What? Okay, to prepare financial statement from historical record. Then what happened next to those financial statements that you prepared from historical record?
For decision making, sir.
You said for decision making, right?
Yes, sir.
Okay. Objective is to prepare financial statement from historical record for decision making. That's correct. Okay, just a minute. I'm trying to set up my own personal hotspot so I can leave this hotel network. I think their network is not giving me what I want. Just few seconds. I want to set up my personal hotspot. Then we'll have an uninterrupted class. Okay, I'm coming. Almost there. Just few seconds. I'm almost there. Okay. Done. Okay, it's loading. So when it is ready, I will let you. Okay, so let's move on. So basically, as an accountant, the objective of why you are an accountant, basically, someone said to prepare financial statement from historical record. So the other one says for decision making. So I think if I marry the two together, both of you are, it's very, very correct. So I need to marry both of you. Okay, historical record, married decision making. Because when you prepare something from historical record, it is basically for decision making. So that is why why we're an accountant. That was the question I asked you. We're an accountant because we are to provide information about the financial statement, okay, and the information that we provided, some people will use it for decision making. That is basically the reason why we are an accountant. So the objective of financial statement basically is to provide information about the financial position or performance and change financial position that is going to be used by a wide range of users for decision making. So that is the objective of financial reporting. Basically, our job is to provide information about the financial statement, which will now be used for decision making. So that's the objective of financial statements. I hope that is clear, right? So if you as an accountant, you prepare an account that contains a lot of misinterpretation, and some people now relied on your account and they lose some monies or whatever, do you know you can be sued for that? Okay, you can be sued for that. So you have to be very careful with the kind of information that you provided as an accountant. Okay, just a minute. Let me switch to my hotspot. My hotspot is ready. Just a few seconds. Yeah. Okay. So I'm using a better network now. I've left this hotel useless network. All right, so the objective is, I've already explained the objective is that the objective is to provide information about the financial statements, okay, of an entity that will now be used for decision making. So whatever thing you are doing in accounting or financial reporting, some people will use it for decision making. So decision making basically is the main reason why you are there as an accountant. Whatever data you are, whatever voucher you are entering to the system, whatever report you are preparing, someone will rely on it to make decision. Okay, so you have to be very careful with the kind of information that you prepare. If you prepare a wrong report and people depend on it and they lose some money, you can be jailed for that. Okay, so you have to be very careful. That is why the goal of our motto in ICANN is accuracy and integrity. We should be sure that whatever information we are preparing is accurate, and also in all situations we should always maintain integrity. Okay, all right, so who are the users that depends on your financial statement? The users are your investors, the present and potential investors. They are the users. Okay, what do they need it for? They use this investor need it for investment decision making, right? Whether to invest or not. Then another users are the employees. Of course, you all need to know how your company is performing so that you determine whether it is time for you to request for salary increase or not. So employees need it for salary or wages negotiation. Then the next one is the lenders. The lenders are the bankers to know whether they can give you more loan or not. Then we have the suppliers to whether they can give you credit facilities or not. So everybody here that I'm listing, their objectives are different. What they need it for are quite different. Okay. Customers want to know whether you are a responsible company that they can rely on for the future. Government too. Government need it for tax purpose. Oh, how much is this company making? What is the tax they have paid? Government need it for tax purpose, and general public too, for research, just to have information. So everybody needs financial statement for different reasons. So you need to understand who are the users of financial statements and their information need. Okay, so that is for that. All right, so let's discuss the underlying assumptions, right? What are the underlying assumptions in the preparation of financial statements? So let's discuss the assumptions. So normally there are basically two underlying assumptions in the preparation of financial statement. I'm sure you have been taught this in your FR level, but let me quickly recap again. There are basically two underlying assumptions. So the first one is the accrual basis, and the second one is going concern basis. So let me explain. So under the accrual basis now, so your transactions are recorded using the accrual basis of accounting. So can someone tell me the meaning of accrual basis? Let me cover this so I don't read. Can somebody tell me what you understand by accrual basis, please? What is accrual basis?
Is a concept of accounting that revenue is recorded when it is earned, and then expenses are recorded when they are incurred.
That is a professional response. Aisha, well done. One bottle of Coke for you. I'm owing you. Okay. So accrual basis simply means that is a method of accounting whereby you only record your revenue when it is earned and not when you receive the money from the customers. And expenses is accounted for when you have received the economic benefit and not when you paid. For example, in the sales of goods now, you recognize revenue, your sales, the moment the risk and reward have been transferred from you to the customers. That is, if you have delivered the goods, that is when you recognize sales, not when the customer pay or not pay. So that is not, so that is what accrual basis is talking about, that you record transactions when risk and reward has been transferred or enjoyed, not when cash is received or paid. So the first thing you must have at the back of your mind when preparing financial statements is this accrual basis. So you must understand this accrual basis first. Okay, so that is the first thing you need to understand. Then the second one is going concern basis, going concern basis. So under the concept of going concern, so you must prepare your financial statements with the assumptions that the company will continue to operate for an unforeseeable future. Okay, that is, you must prepare it on the assumption that the company will continue to operate for an unforeseeable future. So that means that you should have this at the back of your mind. So if the company will not be able to operate for an unforeseeable future, then you must disclose the reason for such. So that's like a threat to going concern. Okay, so the company should be able to operate for an unforeseeable future. So these two things are the underlying assumptions that you must always have when preparing any financial statement. Number one is the accrual, that is that the transactions are recorded on accrual basis. Number two, that is the going concern, that is the business will continue to operate for an unforeseeable future. So that's just the end of the chapter 1 of the framework. Remember, chapter 1 is the objective of financial reporting, which we have just dealt with now. Okay. Now let's move on to chapter 2 of the framework. So chapter 2 of the framework talks about the qualitative characteristics of useful financial information. Qualitative characteristics of useful financial information. So that is what we have under chapter 2. Qualitative characteristics of useful financial information. Someone is at the gate. Let me admit the person. Adetunji Noah. So admitted. So qualitative characteristics of useful financial information. That's the next thing we are discussing. Now, those characteristics are grouped into two. The first one is fundamental, and the second one is enhancing. So what do you mean by fundamental? Fundamental means that something you cannot compromise. It is very, very important. Enhancing are those additional qualities or features. So let me chat with one of my guys here. Ladies, just watch us. So let me chat with one of my guys here. Can any guy please unmute, speak? I want to chat with you, just for us to understand this concept very well. Any guys on this call, please speak up, speak. Any guys here? Oh, there are a lot of them. They don't want to speak. Okay, I'll call you guys out now. Let me call the first person I'm seeing here is, okay, let me chat with Abdullah Suleiman. How are you, Abdullah? Can you speak?
Good morning, I'm fine, sir.
Oh, awesome. So let's me and you discuss these qualitative characteristics of useful financial statements in a practical sense. I said that those characteristics are grouped into two. We have the fundamental characteristics and enhancing. I now said that fundamentals are those characteristics that are very, very important that you cannot compromise. Abi? I now say that enhancing, there are those added features that, okay, you can just, that they are like added features. Okay, you can do without, you can still manage, but they are added, but fundamentals are something that you cannot manage, that they must be compulsory. So are you married or single, sir? That's the next conversation. Married. Okay. Now, before selecting your wife now, what are those fundamental things that you tick as your checklist? Just let's learn from you.
I think number one must be God-fearing.
Oh, okay. I know. Just give me two, and that's all.
Sir?
One more.
Must be presentable.
Okay. Now, guys, class, according to Adetunji now, in selecting his wife, thank God, at least he's happily married now, glory be to God. The fundamental things that it takes, that he cannot compromise. Number one, she must be God-fearing and she must be presentable. So if any of those two things are missing, she will not go for it. So those are the fundamental things that he considered. So fundamental means you cannot compromise them. So when you're preparing your financial statements too, you must watch out for this fundamental. Then what are those other added advantage, boss? that added advantage that you can still do without, but still they are important to you?
I think she must be interactive also. She must be a
Okay.
moody person.
And must not be a word noisy, Abi.
I didn't get that, sir.
You said interactive and what?
Hardworking also.
Okay, all right. I'm done with you. Thank you, sir. You can mute back. So, based on what you said now, his own enhancing, she must be very interactive and hardworking. Note those two things there, they are not a deal, they are not something that it can still manage, even if those features are not necessary. It can still manage. So those ones are enhancing. So enhancing, they are like an added qualities. But the fundamental are those ones like the God-fearing, those ones, he presentable, he does not want to compromise. If she's not presentable, he won't be interested in her. If she's not God-fearing, he will not be interested. So that is just how to understand these qualitative characteristics. Now let's leave let's come back to class. So under the fundamental now, so we have relevance and faithful presentation. Relevance. So relevance means that any financial statement you are preparing must be relevant for decision making. So if it is not relevant, then forget it. That one is very important. It is fundamental. If something is not relevant, then you should forget it. So we cannot compromise that. Then the second one states faithful presentation. Faithful presentation means that it should be true and fair. You should not tell lies. You should not lie. Faithful presentation. So if the concept of relevance and faithful presentation is missing, then your financial statement is lacking integrity. So these relevant and faithful presentations, they are the fundamental characteristics that we cannot compromise, please. Okay. Then the next ones are enhancing. So enhancing are the added features. Like in his own case now, hardworking is enhancing, although he can still go with her, even if she's not hardworking. That's not compulsory, but just like an added features. So here too, the enhancing our comparability, that is, we should be able to compare the financial statement for this year with that of previous years. That's the comparability. We should be able to compare. Then verifiability is any content that we have in the financial statement, we should be able to verify. We should be able to authenticate it, the content. That's the verifiability. Then timeliness, meaning the period of reporting, at least you should be able to report the information you have in your financial statement once in a year. That's timely. At least once in a year, you should prepare your financial statement every 12 months. Then the fourth one is understandability, meaning anything that you should not prepare your financial statement with ambiguity. Start using big grammars. You should prepare it in a simple and easy to understand language, right? So those are the qualitative characteristics of financial statement. Please note this. These are the area that I can love a lot. They love it. That's why I spend much time here. So you should know which one are the fundamental, and you should know which ones are enhancing, right? So the fundamental are the relevant and faithful representation, and enhancing our comparability, verifiability, timeliness, and understandability. So that's just the with two. Now, so these are the what you understand. However, there are some constraints in getting this thing done. Okay, you know, in Yoruba they used to say that obeto dun owo lopa, like that is sweet waste, soup waste sweet require a lot of money, right? So there are some constraints too in meeting up with this objective. The number one constraint is there is usually a trade-off between your timeliness, between the available time, and ensuring that all these financial statements make sense too. That is, you need enough time to be able to achieve all these qualities too. So time is always a factor when preparing financial statement. Time, because most people don't only have time to go into detail. So what you can do basically is to provide the maximum information that is available. Then the second one is that is usually a trade-off between the cost of preparing and the whatever. So because before you can achieve the quality financial statement, you need to spend money too. That is, you need to employ a good accountant, a good auditor. So if you are not making more money, how will you be able to employ these people? You end up employing a quack now. So there is usually a trade-off between the cost and benefits too. Okay, because if you want to get a good hands that will do all these things for you, you will spend money as well. So that is basic things too. All right. So the overall objective is that the cost of providing this information should not exceed the benefits to be derived. You must always watch out for the cost benefit analysis. The cost should not exceed the benefits. All right. So let's discuss the chapter. Sorry, I hope you guys are following. So can somebody tell me what is chapter 1 of the framework, please? Anybody? Fast. Chapter 1 is what? Anybody, please speak. Chapter 1 is what? Oh,
Objective of life.
Objective of
International Accounting Standard Board.
okay, objective of financial reporting. That's chapter 1. Then chapter 2 is what?
Underlying assumption.
Is that chapter 2 really?
Qualitative characteristics of useful financial information.
Okay, please. Chapter 2 is a characteristics. Then the chapter 3 is a financial statements and reporting entity. That's chapter 3. Financial statements and reporting entity. That's chapter 3. So let's discuss chapter 3 also. So let's discuss this chapter 3. Chapter 3 is financial statements and reporting entity. So let's discuss what's a reporting entity now. A reporting entity is an entity that is required or choose to prepare financial statements and not necessarily a legal entity. So any entity that choose to prepare a financial statement, that is a reporting entity. So reporting entity is an entity that choose to prepare a financial statement. That is a reporting entity. So once you decide to prepare a financial statement, then you are a reporting entity. So the next one is financial statement. So what is a financial statement? Financial statement is a form of report that provides information about the assets, liabilities, equities, and equity, income, and expenses of an entity. So your financial statement, basically, they are those reports that provide you information about your asset, liability, equity, income, and expenses, such as your examples are your balance sheet, which is known as the statement of financial position, and your profit or loss, right? Those are the examples of your financial statement. Then we have 3 types of financial statements. Okay, we have 3 types of financial statements. So the first one is the consolidated financial statement, so which is known as your group account. So this is a separate topic that we will be discussing later on. Consolidated financial statement, which is known as a group account. So this provides information about the parent and its subsidiaries. So that's the group account. We'll discuss this one later on. Then the second one is the unconsolidated financial statement. So this is basically the financial statement that is yet to be consolidated, e.g., the account of the parent company separately and the account of the subsidiaries separately before consolidation. That is known as the unconsolidated financial statement. That is financial statement that is yet to be consolidated. Individual records of the parent and subsidiaries, that's unconsolidated financial statement. Then the third one is a combined financial statement. Someone is at the gate. Esther, why does Esther keep coming and going? So the next one is a combined financial statement. So this combined financial statement basically is provide information about the asset, liability, equity of 2 or more expenses, 2 or more entities that are not linked by parent or subsidiary relationship. So when you have 2 entities that are just combining their accounts, but they are not really parent or subsidiaries, that is what we refer to as a combined financial statement. So these are the 3 types of financial statement. Consolidated is the group 1, is a separate topic that we'll be discussing later on. Unconsolidated, that is the account of the individual entities before consolidating them. while combined is the account of two or more entities that are not related, okay, that are not parents or subsidiary, their respective accounts. That is what we refer to as a combined. So that's the end of chapter 3. Now, the next one is chapter 4, okay? Chapter 4. So let's discuss what is chapter 4. So chapter 4 basically talks about the elements of financial statements, okay? That's elements of financial statement. That's chapter 4. So what are the various elements of financial statement? There are 5 elements of financial statements. There are 5 elements of financial statements. They are asset, liability, equity, income, and expenses. So these are the 5 elements of financial statements: asset, liability, equity, income, and expenses. So let's discuss each of them one after the other. So let's discuss each of them one after the other. So how does the framework define an asset? How does the framework define an asset? Okay, so basically an asset is a present economic resource controlled by the entity as a result of what? Past events. So when you are defining an asset, you should know that before you can have an asset, there must be a past event. So that past event could be as a result of acquisition you have purchased, or you lease. You can even lease an asset. Either you can purchase either by cash or credit, but something must have happened in the past before you can have an asset. So it's an economic resource, and that economic resource will now have the potential of producing future economic benefit to you from continuous usage. So when you have an asset now, you should be able to enjoy economic benefit that is from the continuous usage. E.g., you purchase a car now. A car is with you. The past event is the acquisition, whether you buy it on credit or hire purchase. That's a past event. Now, economic benefit is from you using that car. That is what we mean by the economic benefits. Okay, so that is what you are enjoying from using that car. That is an economic benefit. So you need to take note of this definition. There are a lot of standards that talks about assets, e.g., we have IAS 16 that talks about PPE, IAS 2 that talks about inventory, IAS 40 that talks about investment, property. We have IFRS 9 that talks about financial assets or financial instruments. IAS 36 talks about impairment. IAS 38 talks about intangible assets. IFRS 5 talks about asset held for sales. IAS 41 talks about agricultural assets. So there are more than 10 standards that talks about asset alone. So I believe my colleagues will do justice to each of these standards. Okay, so you need to know that asset is the resource controlled by an entity as a result of past events. Okay, and it has the potential of producing future economic benefits to the entity. So that is basically what the asset is all about. Then the next one is a liability. So liability basically is the present obligation of the entity. Okay, present obligations. When you have a liability, that means you are owing. That's the present obligation of the entity to transfer an economic resource as a result of what? Past events. So is your obligation is a liability, meaning that you are owing, you have an obligation. And there can never be any liability without a past event. There must be a past event before you can have any liability. There must be a past event before you can have any liability. So please take note of that. So liability, so e.g., you can't just be walking on the road and somebody will come and meet you, hold your clothes, pay me my money, pay me my money. The first thing you ask the person is that, what happened? What did you do to me? Or what did you do? What service did you render before you can be asking me for money? So there cannot be any present obligation without any past events. So that is basically liability. You are only owing today because you have enjoyed a service in the past which you have not paid for. All right. So that is a liability. Then equity. So this is basically the residual interest in the asset of the entity after deducting all its liabilities. So the residual is known as the equity. So it is the balance, that is, you can say asset minus liability is equal to equity. Asset minus liability is equal to equity. Then income, these are the inflows that comes into the business. So there are increase in assets or decrease in liability that result in increase in equity. So these incomes too, they are grouped into two. We have the one we call revenue, and we have the one we call other income. So revenue are those income that you generate from the ordinary course of the business. So IFRS 15 we address revenue issues. So those income that you generate in the ordinary course of the business. So IFRS 15 we address that. Then other income, there are those income that come from other sources other than the ordinary course of the business. Then expenses is the opposite of the income, right? So any outflow that you incur in the ordinary course of the business, those are your expenses. And note, whenever you declare dividend, whenever you pay dividend, that's not an expenses, it's just a reduction in your equity. Dividend paid is not an expenses, it's just a reduction in your equity. Okay, so that is all for the chapter 4. Now, so the next one is chapter 5. All right. So I hope you guys are with me, please. Hello, guys. Are we together?
Yes, sir.
Okay. So let's discuss chapter 5. Who is at the entrance? Esther. Okay. So chapter 5. Let's discuss chapter 5, recognition and the recognition. And you know, the good news is that whatever thing we are discussing now is being recorded. So after this class, I will download the video and share the link with you. So you all of you can download it. You can listen to this class as many times as possible. Just once you download it, it's only once. After that, you don't need to use data again. You can be playing it directly from your device. So that's one of the benefits of online classes. So you can listen to these things all over again as many times as possible. Okay, so the next one is the recognition and the recognition. So let's discuss what is recognition. Oh, who are the people coming and going? Rebecca. Okay, I've admitted I again. Okay, so what is recognition basically? What is recognition? So recognition is a process of including an item in the financial statement. So before you can include an item in the financial statement, it must have met up with the definitions of any of the elements. Is either it is an asset, liability, equity, income, or expenses. So the process of including an item in the financial statement is known as what? Recognition. So that's the process of including an item in the financial statement. So that is what is referred to as what? Recognition. So there are some recognition criteria that I'm going to explain to us now. There are some recognition criteria, e.g., for an asset now, before you can recognize any of the elements that we've discussed above, you should be certain that the elements it's probable that any future economic benefit associated with the item will flow to or from the entity, right? That is, economic benefit is very, very important, future economic benefit. And also, you should be able to determine the cost of such transactions. If you don't know the cost, then what do you want to recognize? You should be able to determine the cost before you can recognize. So that is very important for recognition. So you should be able to determine the cost. Now, the second one is the recognition. So what is the recognition now? The recognition is the process of removing an item from the financial statement. That is the recognition, the process of removing an item from the financial statement. That is what is referred to as the recognition. All right, so for an asset now, how do you remove an asset? You remove an asset when you dispose of the asset, or you no longer have control over the asset through disposal, or the asset probably has been written off, is scrap, then you remove it. So that is when you remove asset. So when the entity loses control or the asset is null, or part of the asset itself, then you remove it. Where do you remove liability? You remove liability when the liability has been extinguished, meaning you have paid off. E.g., I am owing you 10 naira and I paid you your money, so there is no liability again. So when the obligation is settled, then you can remove the liability from the financial statement. So that is how you derecognize an asset. Okay. So chapter 5 talks about this recognition and derecognition, which we have just explained now. The next one is chapter 6. Okay, so chapter 6. Oh, sorry, I skipped. I did something. Chapter 6 is where we had now. Chapter 6. So what does chapter 6 state? So under the chapter 6 now, we have the measurement. Now, the measurement is divided into two, basically. Measurement is divided into two. You know, the first one is the historical measurement basis, and the second one is the current value measurement basis. So these are the two measurement criteria that we have. We have the historical measurement basis and the current value. So under the historical measurement basis, this is when you recognize transactions using the cost at which it was purchased or it was recognized. E.g., you bought a car for 20 million naira last year. So that 20 million naira of last year is the historical cost, right? So you are using the value at which the transaction took place. That's your historical basis. It's always a past value. Then this current measurement now is divided into three. We have the fair value, we have value in use, and we have the current cost. So when we talk about fair value, so this fair value simply means is IFRS 13. I think Surprise is the one that will take you this topic, IFRS 13 or so. So fair value basically is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. That is what is referred to as a fair value. E.g., if you want to buy a phone now, you have to go to the market where the phone is selling in large quantities so that you can determine the appropriate price. You can go to Computer Village, for example, that there is market for phones or laptops there. So that is fair value. So for you to be able to determine the fair value, both the buyer and seller must have knowledge about the product, okay, and they must be willing to sell. So that is how you determine your fair value. Yeah. So for fair value now, you must go to the market where there is a market participant and everybody will have information about the product. So that is how to accurately determine your fair value. Then for value in use now. So value in use is basically when you discount your expected future cash flow. E.g., you have a plant now, and you have anticipate that the plant will be used for 5 years, and each of the year you can determine the expected inflow that the plant will generate. So if you now discount all those future cash flow using the current present value, current discounting rate, that is what is referred to as what? Value in use. So in the case of an asset, it is called value in use, while in the case of a liability, it is called fulfillment value. So you will be taught how to calculate value in use under IAS 36 impairment. Okay, that will be taught. It will be discussed with you. Then the last one is known as a current cost. So this current cost basically is known as your replacement value. I have a car now. If I want to replace the car and get the same car again, how much is it? That's the replacement value, is your current cost. So the price that will be paid or received for an equivalent asset, for a particular asset. You have Toyota Camry 2013 model now that you bought 3 years ago. You now want to go and buy the same car again, the same specification. Or how much does it worth? That's your replacement cost or your current cost. Okay, so that's for that now. All right, so the next one is chapter 7. So this chapter 7 basically talks about the presentation and disclosure. It talks about the presentation and disclosure. So under the P&L, there are some things you disclose, which I don't need to even discuss about this. You know what you have in your P&L, your revenue, expenses, cost of sales, like that. then you know what you disclose under your other comprehensive income as well. So I need not bother about this. And you also know that there are some instances whereby you can reclassify the transactions you have in your other comprehensive income back into your profit or loss. So you can reclassify. For example, now if an asset currently have a revaluation surplus or revaluation reserve in your other comprehensive income, and such an asset is now disposed, you are required to reclassify whatever value you have in your revaluation reserve to your P&L through retained earnings. Then also for financial instruments too, the moment the status of your financial instrument change from available for sales to another method, whatever balances you have in your revaluation reserve, you must in your OCI, other comprehensive income, sorry, you have to reclassify. So this will be taught at the respective standard by each of the lecturers that will take care of those standards. Okay, so that's what you do there. So I think this should be the last one, the capital and capital maintenance concept. Now, under the capital and capital maintenance concept, what this principle entails is basically how you measure profit. How you measure your profit, that is what this principle entails. Okay, now there are two methods that you can use to measure profit. The number one is the financial capital maintenance concept, and the number two is your physical capital maintenance concept. So that's it. So under the financial capital maintenance concept now, your profit is recognized if the closing net asset exceed the opening net asset. So here, under the financial capital maintenance concept, you are comparing net asset alone. Okay, the moment your closing asset exceed your opening asset after excluding any distributions like dividend and co, whatever balance you have left is your profit. Let's assume that our closing net asset is 10 million, and at the beginning of the year, it was 9.5 million. So what it means is that we have added 500,000 value this year. That's like a profit, okay? That is what is referred to as a financial capital maintenance concept. So this one's measure profit by using the net asset principle, okay? Then the second one is physical capital maintenance concept. So this wants to measure profit using productivity, how productive you are. So here, if your closing productivity exceeds your opening physical productivity, then profit is the difference. So under physical capital maintenance concept, you focus more on the physical productivity, while under the financial capital maintenance concept, you focus more on the net assets. Okay, so I think I'm done with the chapters. So those are the 8 chapters. Let me recap each of the chapters before we move on to the other area. Okay, so note that the chapter 1 talks about the objective, where we state that the objective is to provide information for decision making. Then chapter 2 talks about the characteristics, where we discuss the various characteristics of the fundamental and enhancing. Okay, then chapter 3 talks about the financial statement and reporting entity, where we discuss that there are 3 types of financial statement: consolidated, unconsolidated, and combined. Then chapter 4 is the element. We define assets, liability, equity, income, and expenses. Then chapter 5 talks about the recognition, where I explain what is recognition. That is the process of capturing an item in the financial statement, and the recognitions too, that is the process of removing an item from the financial statement. We discussed that as well. Then chapter 6 talks about the various measurement basis: historical cost using the past cost or the current value, where the current value is divided into 3. That's your fair value, value in use, and the current cost. Then under chapter 7, we review the disclosure and how you recycle an item back to profit or loss. Then chapter 8 talks about the capital and capital maintenance concept. So those are what we discussed there. So lastly, let's quickly, we have one more things to do. So let's review so I said earlier on that IFRS is principle based. Okay, so let's look at the difference between principle based and rule based. Okay, so IFRS is principle based because it allows you to use your initiatives, right? So it allows you to use your initiative. So let's read what is there now. So principle-based accounting, it seems to be the most popular accounting method around the world. Most countries opt for a principle-based as it's often better to adjust accounting principle. You can see now, to adjust principle to a complete transaction rather than adjusting the combination to specific accounting rules. So here, you can adjust the principle, you can tweak it to fit into your own operation, rather than you trying to shift your operations to meet up with the rule. So that is what principle-based. You know, I said that principle-based allow you to use your initiative, but your initiative must result into something that will give a better presentation. So that is why IFRS is more of principle-based. However, we have rule-based too. Like in US now, US GAAP is rule-based, okay? US GAAP is rule-based. So in rule-based now, you cannot tweak anything. If the standard says that you should follow ABC, you cannot change any damn thing. You must follow the ABC to the latter. That is why it is called rule-based. You must obey the rule to the latter. So in US now, their own is rule-based. So they follow it. They are very strict with their rule, unlike IFRS that is flexible. But rule-based simply means that you must follow the rule as it is stated. So rule-based is basically a list of details rules that you can see the word is must, that must be followed when preparing financial statements. So the US GAAP, that is why US have not migrated to IFRS. They are still using their own US GAAP because their own US GAAP is rule-based. Okay. All right. So basis of accounting, I've explained this I've explained this before, accrual basis. We've discussed cash basis. Okay, cash basis, you know, the cash basis is the opposite of accrual basis. Under the cash basis, transactions are recognized in the period in which cash and receipt occur. That is what is meant by cash basis. Here, it is only when you receive money or you paid out money. That is when you recognize transaction. That is what the cash basis is all about. Okay. Then breakup basis simply means you apply this breakup basis when the going concern of an entity is under a threat. That is when you apply the breakup basis. So you apply breakup basis when the going concern is under a threat. So under breakup basis, transactions are recognized at realizable value or for sales value, if that is better word. Okay. There is no fair value under breakup basis. Nothing is fair again, because the business that is already in trouble, you must recognize all their asset and liability at their realizable or breakup value. That is the principle of breakup basis. Okay, so that's just the summary. So when we meet in the class, we'll continue from IAS1. So what we have done now basically is to quickly analyze what we have under the Iasb conceptual framework. So Rebecca, you have a questions, over to you, please. Rebecca, please ask me your question. Meanwhile, okay. Yeah,
Hello,
continue.
sir. Okay, my
Continue.
question, you made mention of replacement cost and fair value. I want to know the difference between the two.
Okay, fair value basically is the amount, okay, that a transactions can be purchased, okay, between a knowledgeable willing buyer and seller, okay, in a place where the market exists for that transaction. Whereas for your replacements or current cost, if you want to replace the immediate asset now, how much can you obtain for that? So the two are somehow similar, but replacement cost doesn't really focus on the market. Where you are, your location, if you want to replace your asset, how much can you get it? Whether the market exists or not, how much can you get from replacing that asset? But for fair value, you must go to the place where the market exists to be able to determine the fair value. Are you with me? So location is always a factor under fair value, but under replacement, location is not a factor. You just consider how much can you realize if you want to replace this asset right now. I don't know, is that clear to you, Rebecca?
Yes, sir. Another question is,
Please go ahead.
okay, for instance, an asset, can I categorize or can I classify a waste bin as an asset?
Okay, a waste bin as an asset. Okay,
Yes, sir.
the question. Okay, technically speaking, a waste bin is an asset to you, right? It's an asset if it meets up with your capitalized your threshold. But the question is it an inventory or a PPE? That's another thing entirely. So in doing that, how do you determine whether it's an inventory or a PPE? Will that waste bin generate economic benefit to you over a period of time? Will it exceed a year? If the waste bin will be used for more than 1 year, then that's a PPE. But if your waste bin will be consumed in less than a year, that's like consumable, your inventory, which will be consumed in the production process. So whether it's a PPE or inventory depend on the useful life, on how these waste bins will be used over the production process. If it will last for more than 1 year, then you can take it as PPE and depreciate it over its useful life. Then if it is going to be consumed in a year, that's inventory or consumables. Also, you might be thinking that what about if the amount is so small, it's just a waste bin now? That is where we have the concept of aggregation and materiality. One waste bin may not be material to you, but by the time you now consider like 100 or 200 waste bins together, then the issue of materiality will start coming, right? I don't know. Have I answered your question? I don't want to go deeper beyond this.
Yes, sir. Thank you very much, sir.
All right. So, any other questions for me, please? Anybody? Let me stop recording now so that I can archive the videos. Let me stop so I can archive the video and send it to you guys, hopefully later today. All right. So we are done with today's class.